The central bank governor who is briefing on the outcome.
Weak aggregate demand associated with less than full employment in labor markets, particularly partially functioning supply chain networks, the rapid spread of the new variant of the coronavirus, and a high infection rate dampened the initial rebound in the economic recovery towards the end of 2020. Output growth in the emerging market and developing economies remained uneven across countries. In China, for instance, output slowed marginally in the third and fourth quarter of 2020, following a faster than expected rebound in the second quarter of 2020. Following the lull in the second quarter, India's economy grew sharply in the third quarter, reflecting welcome adjustments to the stimulus measures. Accordingly, the International Monetary Fund, the IMF, estimated global growth in 2020 as a contraction of 4.4% and forecast growth in 2021 to improve to 5.2%. This forecast is, however, hinged on the successful vaccination of a significant number of people to create the much desired herd immunity. On price development, the MPC noted that inflation in most advanced economies is likely to remain subdued in the short to medium term, as the recent rise in COVID-19 infection and mortality rates have resulted in suboptimal employment and weakened labor markets, which have dampened aggregate demand across these economies. In the emerging markets and developing countries, however, inflation remains relatively high compared with the advanced economies, with some economies confronted with stronger upside risks than others as a result of weak accretion to reserves, persistent exchange rate pressures, poor inflow of capital, as well as long-standing structural issues. The Monetary Policy Committee noted the steady build-up of systemic liquidity across global economy arising from the support by fiscal authorities and central banks to bolster the recovery and return confidence to the financial markets. It noted that the response to the pandemic has heightened the risk of debt accumulation, raising concerns of debt sustainability and vulnerability of the global economy to financial crisis once central banks commence normalization of monetary policy. Domestic economic development. Real gross domestic product, according to the National Bureau of Statistics, contracted by 3.62% during the third quarter of 2020, compared with a contraction of 6.1% in the second quarter of 2020 and a growth of 2.28% during the corresponding period of 2019. The real GDP contraction during the third quarter of 2020 was largely driven by the decline of 13.89% in the oil sector from 6.63% during the second quarter of 2020. The non-oil sector also contracted by 2.51% during the third quarter of 2020, compared with 6.05% in the second quarter of 2020. The weak performance observed in both the oil and non-oil sectors was largely attributed to the lag effects of the lockdown, persisting weak global demand for crude oil, and security challenges across the country. The MPC noted with concern the continuing sluggish recovery in the manufacturing and non-manufacturing purchasing managers' indices, which remained below the 50 index points benchmark in December 2020 at 49.6 and 45.7 index points respectively, compared with 50.2 and 47.6 index points in the previous month. This weak performance was attributed to the resurgence of the pandemic, foreign exchange pressures, increased costs of production, general increase in prices, and decline in economic activities. Similar trend was also observed in the employment level index component of the manufacturing and non-manufacturing PMIs, which contracted for the 9th consecutive month in December 2020 to 46.3 and 45.1 index points respectively, compared with 50.2 and 46.7 index points during the previous month. The committee, however, noted that current growth headwinds would likely moderate in the short to medium term as the containment measures and the sustained implementation of economic stimulus permeate the domestic economy. Committee expressed concern on the persisting uptick in inflationary pressure for the 15th consecutive month, with headline year-on-year inflation moving further up to 15.75% in December 2020 from 14.86% in November 2020. This uptick was attributed to the increase in both the food and core components of inflation, which rose to 19.56 and 11.37% in December 2020, respectively, from 18.3 and 11.01% in November 2020. This continued upsurge in food inflation was attributed to the logistical bottlenecks spurred by the increasing security challenges in many parts of the country, which had disrupted food production and supply to the market. Other factors driving the core inflation include the recent deregulation of the downstream sector of the oil industry, which led to the hikes in the price of petrol and the upward adjustment in electricity tariff. The committee, however, noted that as output rebounds, supported by the suite of stimulus packages by both the federal government and the central bank, inflationary pressures will likely begin to moderate in the near term. On the performance of monetary aggregates, the committee noted the further growth in broad money supply M3 to 10.97% in December 2020 from 5.02% in November 2020, driven largely by the growth in the net foreign assets. It also noted the expansion in net domestic assets to 4.96% from a contraction of 0.5% during the previous period. Aggregate domestic credit also moved further up by 13.40% in December 2020 compared with 9.48% in the previous month. This was largely attributed to the bank's policy on loan-to-deposit ratio, complemented by the bank's interventions in various sectors of the economy. Consequently, banking sector gross credit as at the end of December 2020 stood at 25.02 trillion naira compared with 24.25 trillion naira at the end of November of 2020, representing an increase of 774.28 billion just within the interval. The committee noted the improvement in the performance of aggregate credit, which was slightly above its indicative benchmark of 13.2% for 2020. In light of the ongoing synchronized efforts by monetary and fiscal authorities to mitigate the impact of the COVID-19 pandemic, the bank has committed substantial amounts of money towards this objective. Indeed, total disbursement as of January 2021 amounted to 2 trillion. Under the Anchor Borrowers Program, a cumulative sum of 554.63 billion naira to 2,849,490 beneficiaries has been disbursed since inception, out of which 61.02 billion has been allocated to 360,000 farmers during the dry season. COVID-19 targeted credit facility meant for households and small enterprises business, wherein we have disbursed 192.64 billion to 426,016 beneficiaries. We have also disbursed 106.96 billion to 27,956 beneficiaries under the CBN's Agricultural and Small-Scale Equity Investment Scheme. While under the Healthcare Support Intervention Program, we have disbursed 72.96 billion to 73 different projects in the health, hospital, and pharmaceutical sector that comprise 26 pharmaceutical projects, 47 hospitals, and healthcare services projects in the country. To support the provision of employment opportunities for the Nigerian youth, the Central Bank of Nigeria also provided financial support through our Creative Industry Financing Initiative and Nigerian Youth Investment Fund, amounting to 3.12 billion to 320 beneficiaries and 268 million to 395 beneficiaries respectively. On enhancing power supply, the CBN has so far provided 18.58 billion naira for the procurement of 347,853 electricity retail meters to distribution companies in support of the National Mass Metering Program. Our target will be 5 million meters to ensure that all households are effectively metered in Nigeria. The committee urged the bank to sustain its current drive to improve access to credit to the private sector while exploring other complementary initiatives in collaboration with the federal government to improve funding to critical sectors of the economy. During the period under review, money market rates remained low, reflecting the prevailing liquidity conditions in the banking system. Overall monthly weighted average open buyback rates declined further from 1.13% in November 2020 to 1.09% in December 2020. On the equities market, the committee noted the positive performance, particularly the sustained patronage by domestic investors, largely driven by the prevailing low yields in the money market. The all-share index increased by 1.82% to 41,001.99 points as at 22nd of January 2021 from 40,217.72 points on December 31st, 2020. Similarly, market capitalization grew by 1.8% to 21.44 trillion from 21.06 trillion over the same period. This improved performance was largely attributed to gains recorded in the medium and large capitalized stocks, notably in consumer goods, banking, insurance, and oil and gas sectors. Monetary Policy Committee, however, noted the marginal increase in non-performing loans ratio, which rose to 6.01% at the end of December 2020 from 5.88% at the end of November 2020, and above the prudential maximum threshold of 5%. While noting that this development is not unexpected under the prevailing circumstances, it urged the bank to strengthen its macroprudential framework to bring NPLs below the prescribed benchmark. On the external reserves position, the committee noted the increase in the level of external reserves, which stood at 36.23 billion as of January 21, 2021, compared with 34.94 billion at the end of November 2020. This reflected improvements in the oil prices, partial global economic recovery, amid optimism over the discovery and distribution of COVID-19 vaccines by most developed economies. Our outlook. Overall, the medium-term outlook for both the domestic and global economies continue to show improved prospects of recovery, supported by the recent moderate uptick in crude prices and increased optimism over the procurement and distribution of COVID-19 vaccines. Available data and forecasts for key macroeconomic variables for the Nigerian economy suggest further improvement in output growth in the first quarter of 2021. This will be supported by the coordinated and sustained interventions of the monetary and fiscal authorities, including the broad-based stimulus and liquidity injections. Inflationary pressure is also expected to commence moderation as the economy's negative output gap closes. However, underlying uncertainties in the oil market and current uptick in the second wave of COVID-19 infection rate may pose some downside risks to this forecast. Committee's consideration. The committee noted the moderation in output contraction in the third quarter of 2020, associated with news of the discovery of COVID-19 vaccines and rising oil prices. The outlook for the recovery, however, appears to be dampened by the second wave of the pandemic, considering its intensity. In the committee's consideration, it noted that COVID-19 pandemic and the necessary measures put in place by the government to forestall its public health impact, such as the lockdown and other associated restrictions, contributed to the Nigerian economy going into recession, unfortunately, much like almost every other country in the world. Members thus agreed that the committee's current priority remains to quicken the pace of the recovery through sustained and targeted spending by the fiscal authority, supported by the central bank's interventions. In this light, it was thought necessary to increase collaboration with the fiscal authorities by providing complementary spending to finance productive ventures in a bid to improve aggregate supply and reduce prices. This is in addition to effectively collaborating with the Presidential Task Force on COVID-19 through the existing private sector coalition against COVID-19, CACOVID, to procure and distribute vaccines to fast-track the pickup of business activities and economic recovery. Members reiterated the adverse impact of insecurity on food production, stressing that the current uptick in inflationary pressure could not be solely associated to monetary factors, but due mainly to legacy structural factors in the economy, including major supply bottlenecks across the country. The committee thus called on the government to redouble its efforts at strengthening infrastructural efficiency and address the emerging security challenges in the country. In addition to this, the committee called on the government to explore the option of effective partnership with the private sector to improve funding sources necessary to address the huge infrastructural financing deficit. The committee expressed concern over the rising public debt stock as recurrent expenditure remain relatively high compared with capital expenditure, thus signaling future debt servicing challenges. To improve government revenue sources and investment in capital, committee called on the government to take advantage of the takeoff of the African Continental Free Trade Area, AFCFTA, which could boost domestic production and generate sizable revenues for government, as well as providing domestic productivity and competitiveness. The committee commended the bank's efforts in improving liquidity in the foreign exchange market, but noted the need to continue to explore avenues to improve inflow from sources such as through the international money transfer operators, diaspora remittances, and non-oil export promotion. Given the current trajectory of crude oil prices, these sources, in the view of the committee, will boost foreign exchange supply and ease the current exchange rate pressure. The committee noted the continued improvement in the equities market as a lead indicator of medium-term macroeconomic recovery, thus urging the bank to maintain its collaboration with the fiscal authorities to improve the investment climate towards attracting sustainable foreign direct investment. Committee commended the bank for maintaining a sound regulatory surveillance over the banking system by ensuring a reasonably low level of NPL, non-performing loans, even with the aggressive credit expansion program during this crisis period. Though NPLs remain slightly above the prudential benchmark, members noted that the banking system remained stable, strong, and resilient. Given the success recorded under the loan-to-deposit ratio policy. It thus urged the bank to sustain its risk surveillance approach and ensure the continued soundness of the banking system. In the committee's consideration, it noted the broad-based global stimulus packages, including expanded credit lines, asset purchase programs, corporate bond purchases, additional funding facilities for financial system, commercial paper purchases, special central bank lending, increase in the ways and means limits introduced by the central banks all across the world and in different countries to support economic recovery in their various economies and to prevent further distortions to the economy caused by the devastating impact of this pandemic. The committee noted the large stimulus packages deployed by many countries to fast-track growth recovery and restore livelihoods across the world. For instance, Japan provided stimulus package valued at 66.9% of its 2019 GDP. UK, 45.04% of its 2019 GDP. United States of America, 28.4%. Brazil, 27.6%. South Africa, 12.6%. China, 11.5%. India, 10%. Russia, 7%. But Nigeria, paltry 4.5%. The MPC therefore urged the bank to further expand its current stimulus packages to support fiscal interventions to reflate and boost recovery in the economy. Committee's decision. At this meeting, the Monetary Policy Committee was, as in the last meeting, confronted with a policy dilemma as to whether to aggressively combat the inflationary pressure or support measures currently aimed at stimulating growth and reversing the current recession. Although the economy is currently in a stagflation environment with simultaneous occurrence of inflationary pressures and contracting output, the committee resolved to reverse both development and continue pursuing price stability in a growing economy. MPC was of the view that whereas there may be wisdom in loosening, given that the impact of the global COVID-19 pandemic has resulted in constrained activities, disruption to supply chains, and suppresses aggregate demand, an accommodative stance may be required to stimulate credit expansion and boost recovery in the short term. The committee was also of the view that an expansionary policy would enable the monetary policy authorities, convince financial institutions to reduce loan pricing and defer interest and principal repayments to critically affected obligors in a sustainable manner. On the flip side, MPC also opined that an aggressive expansionary stance may worsen both inflation and the negative real interest rate, thereby resulting in negative consequences on exchange rate. With regard to tightening, MPC concluded that this may run contrary to its objective of providing affordable credit to our households, micro, small, and medium enterprises, the agricultural sector, and other output growth and employment stimulating sectors of our economy. MPC was therefore of the view that it should pursue its current stance of systematic synchronization of monetary and fiscal policy accommodation through its development finance initiatives aimed at mitigating the impact of COVID-19 pandemic on Nigerians. While expressing understanding of the public health dilemma of the recent spike in infections, MPC encouraged government not to consider a wholesome lockdown of the Nigerian economy so as not to reverse the current gains of the stimulus earlier provided in 2020. It also encouraged the Central Bank of Nigeria management to aggressively intensify its efforts in providing targeted credit facility to households, to small and medium enterprises, to the health sector, as well as the agri and manufacturing sectors, which would not only boost consumer spending, but result in manufacturing output, thereby positively impacting the GDP. On this basis, the MPC agreed to hold all policy parameters constant. The committee thus decided, by a unanimous vote, to retain the monetary policy rate at 11.5%. In summary, MPC voted 1, to retain MPR at 11.5%, retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, retain the CRR at 27.5%, and retain the liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. And that was the communique of the 277th meeting of the MPC of the Central Bank of Nigeria. Incidentally, Governor, we have a number of questions. These MPC really generated a lot of interest. A number of press sent in questions online, and we have some of them here. And I would first want to introduce them. We have Nancy Nagi, AIT, Chinemere Joseph from Arise Television. We have Biodun Dari, Radio Nigeria. We also have Larry Afolayan from TBC. And then, of course, Sunday Michael from Daily Trust sent in a question. And Abu Wahab Asa, New Telegraph, and Nduka Chieji. I will invite Nancy for your question.
Thank you very much, sir. Good afternoon, Governor and members of the MPC. Let me start with this question. I guess that the Governor, or you would have seen the newspaper reports from business newspapers and other newspapers about what Fitch said concerning FG's deficit monetization by Ways and Means facility with the Central Bank of Nigeria, raising macro stability risk as well as highlighting public finance management weakness, weakening also the balance sheet. I would like you to address that, as even Fitch also mentioned that the CBN's deficit financing predated COVID-19 pandemic shock.
Yeah.
The second question is, all global policymakers right now are making every effort to revive the economies back to recovery. We've seen what just happened even in the US with the new president. I really want to know specifically what the focus of the MPC will be this year. Thank you very much, sir.
Good afternoon, Governor and his team. My name is Chinemere Joseph from Arise News. I have like two questions, but let me start with this one. Governor, sir, you recall that the interest rate dispensation for the bank's intervention facility at 5% is wrapping down as it to loans. It's wrapping down as it ends on March 2021. That's in a few months' time. We know that the pandemic is still very much around us. Would you be extending this 5% interest rate on loans, or what would you be doing? And secondly, we know that the bank, in a number of circulars, indicated that from last year, 2020 and onwards, that first generation will be on diaspora remittance and export sector stimulations. Governor, sir, can you kindly provide some details on this new focus? And you could also tell us how some of these licensed and unlicensed participants are coping with the new policy. Thank you.